Surrender provisions. Permanent life insurance cash values provide important living benefits through policy loans and partial surrenders. Cash value loans. Permanent life insurance policy owners can borrow against their policy's cash value. Policy loans are normally available after the policy is in force for a specified time, typically 3 years. The maximum available loan amount depends on the type of insurance. Fixed life insurance. The maximum loan amount can be as high as 100% of the cash value, less any debt currently outstanding against the policy. Variable life insurance. The maximum loan amount is something less than the full cash value, for example, 75 to 90% of the cash value, less any debt currently outstanding against the policy. This reduces the risk of the unpaid loan being greater than the policy's cash value if stock prices fall. The policy loan interest rate charged by the insurer is usually the lesser of a guaranteed rate stated in the policy or a current rate announced by the company. Most states limit the loan interest rate to no more than 8%. Key point. A cash value loan does not literally draw down the policy's cash value. The loan is provided by the insurer, which uses the cash value as collateral. While the outstanding loan balance accrues interest, the cash value continues earning interest, often at the same rate as being charged for the loan. The loan net rate explains the popularity of cash value loans for living benefits purposes. Repaying a policy loan. Policy owners are not required to repay a policy loan. In one way or the other, the insurer will recoup the outstanding loan balance, including accrued interest. If the policy is lapsed or surrendered, any cash value proceeds distributed to the policy owner will be reduced by the outstanding loan balance including accrued interest. If the insured dies, the death benefit is reduced dollar for dollar by the outstanding loan balance plus accrued interest. As long as the total amount of the loan plus interest is not greater than the cash surrender value, the policy remains in force. If the loan amount plus accrued interest ever exceeds the cash value, the policy will lapse. Automatic premium loan provision. An automatic premium loan, APL, is an optional provision that a life insurance applicant can elect when the policy is purchased or after the policy is issued. There is no charge for this benefit. An APL pays premiums due at the end of a policy's grace period. Its purpose is to prevent a policy from lapsing if the policy owner forgets to pay the premium, or simply can't pay it when due. APL key points include: a premium loan is possible only if the cash value is large enough to cover it. Premium loans become policy loans in all respects, including accruing interest. Insurers may restrict the number of times a premium loan can be taken, either prohibiting consecutive premium loans or limiting the total number available. Partial surrenders. In addition to policy loans, UL policy cash values are also accessible through withdrawals called partial surrenders. The practical result to the policy owner is the same. Money is obtained through the policy for virtually any living benefit need. Withdrawals of any amount are permitted if they are less than the current cash value. The UL policy continues in force as long as the remaining cash value supports the monthly deductions. To reduce insurer costs by keeping policy owners from taking small, frequent withdrawals, insurers usually require that all partial surrenders exceed a specified minimum amount, for example, $250. Key point. Universal life insurance cash value withdrawals, partial surrenders, are not loans, nor do they incur interest charges. Instead, they reduce the UL policy's cash value and death benefit by the amount of the withdrawal. Unlike a policy loan, the policy owner cannot repay a withdrawal. Any attempt to repay is treated as a premium payment that is subject to premium expense charges. Adjustable life insurance partial surrenders. Besides referring to a withdrawal from a UL policy, a partial surrender can also refer to a withdrawal from an adjustable life insurance policy. Because it is a form of whole life insurance with UL features, adjustable life policy owners can access their policy's cash value either through a policy loan or through a partial surrender. Adjustable life insurance policy loans are handled like any whole life insurance policy loan. Adjustable life insurance partial surrenders are not loans but are an actual surrendering of a portion of the policy, with a proportionate reduction of the policy's death benefit and a reduction in the future premium. Example: Ned's adjustable life insurance policy has a face amount of $100,000 and a cash surrender value of $30,000. Ned takes $15,000 from the policy's cash value through a partial surrender. This equals half of the policy's cash value amount. Because the reduction in death benefit is proportional to the amount of the partial surrender, the policy's face must also be reduced by half. So, to partially surrender the policy, Ned must reduce the policy's face amount from $100,000 to $50,000. For your review, a policy loan is provided by the insurer, which uses the policy's cash value as collateral. In one way or the other, the insurer will recoup the outstanding loan balance, including accrued interest. If the loan amount plus accrued interest ever exceeds the cash value, then the policy is canceled. The purpose of the automatic premium loan, APL, is to prevent a policy from lapsing if the policy owner forgets to pay the premium, or simply can't pay it when due. Universal life insurance policies allow partial surrenders, withdrawals, as well as policy loans, from their cash values. A withdrawal reduces the universal life insurance policy's cash value and death benefit by the amount of the withdrawal. Adjustable life insurance allows both partial surrenders and policy loans. Please pause the audio and watch the video. You can restart the audio playback at any time.
A really popular feature with any type of permanent life insurance, that is, any type of policy that has a cash value, is the ability for the policy owner to access that cash value while the insured is alive, that is, while the policy is in force. And they do that for what we call living benefit purposes. The term living benefit is a general term that simply means if the insured is alive and the policy is in force, and you withdraw that money, it's presumably for some kind of a living purpose as opposed to a death benefit purpose. By the way, there's no restriction on what that money can be used for. It can be used for virtually anything that calls for some money. Now, there are two different ways that the cash value can be accessed, and it's important that you understand the distinction between the two, and they are a policy loan or a partial withdrawal, sometimes called a partial surrender. Let's talk about the loan first. A policy loan preserves the cash value and allows the policy to continue to grow as intended. It may be paid back with interest to the insurer, but frankly, it doesn't have to be paid back. A withdrawal or partial surrender, on the other hand, is truly a withdrawal of some of the cash value from the policy. And this has a very direct impact not only on the policy cash value, but also on the policy face amount, since withdrawing money out of the policy through a withdrawal or partial surrender effectively closes or reduces some of the face amount of that policy. This is also described in the lesson. Let's just talk a little bit more about the policy loan, because I think there's a little bit of a misunderstanding among some people about exactly what does that mean and how does it work. Sometimes you'll hear the term used, a cash value loan, and that really is a misnomer. A policy loan does not in any way take money out of the cash value. What the insurance company does is it becomes the lender. It loans money to the policy owner, and it uses the cash value as collateral. It effectively takes the cash value and says, okay, we're going to put a lien on some portion of this cash value equal to the amount being borrowed. The policy owner may pay back that loan, but the insurance company is not worried about it, because if the policy owner does not pay back the loan, they're going to get that money back one way or the other. Either the policy owner is eventually going to surrender the policy, in which case the insurance company will take its share of the cash value plus accrued interest before it distributes any remaining money to the policy owner, or if the policy owner keeps the policy until the insured's death, then the death benefit is reduced by the amount of the outstanding loan. So the insurance company is not worried. It's going to get its money paid back to it. So understand that difference between a policy loan and a policy withdrawal or partial surrender, and you'll be in a good position to explain to your policy owners why one would apply and one would not.
Okay, everybody, here is the questions. The automatic premium loan provision does which of the following? Provides liquidity if the insured wants to increase. Prevents the life insurance from lapsing. Provides cash. Improves the policy owner's credit rating. I'm going to go with from lapsing. Okay, Paul dies with $50,000 unpaid loan, including interest against his policy. What death benefit will the insurance company pay his beneficiary? 100. It would be 100 minus the unpaid loan. I'm guessing that's what it would be. All right, which of the following will happen if the outstanding balance of a whole life insurance policy loan, including interest, exceeds the policy's cash value? I'm going to say it's going to go to extended term. All right, with a variable life insurance policy loans can be as high as 50 to 70%. All right, let's see how we did. 50%. So the last one we got wrong. It's 70 to 90% of the cash value less any outstanding debt. So question 3, the insurer will cancel the policy, which I'm surprised by that. So if the outstanding balance of a whole life insurance policy loan, including interest, exceeds the policy's cash value, the insurer will cancel the policy. All right, so these two I got right. This was just basic math, 150 minus 50. This one here, the APL, prevents the life insurance policy from lapsing. And this was a short and sweet video. Not super long and not super short. So the next one will be life insurance, policy dividend options. Thanks everybody for staying tuned.